Perfect. Yeah, welcome everyone, and excited to kick off this session here. This is the Raising Capital with Confidence, and we're going to be here with Will from Carta as well as Jeff from Forecastr. This is part of the Prepare for VC and Boston New Technology event series. So, Prepare for VC, we offer cohort-based as well as one-on-one consulting and a lot of community programming as well, really all designed around helping startups get ready for both the fundraising rounds and for growing and scaling their ventures. And then Boston New Technology is a tech and startup organization. We joined about a year ago as co-organizers of to really relaunch back into in-person and virtual events after the pandemic. And we have a weekly tech newsletter that goes out. We do virtual and in-person events across the Boston area. And we're also opening up other chapters across the country as well. So yeah, really excited for today's event. We're going to keep it interactive as well, where you can submit in the chat, or there's a Q&A tab for either text-based or more of a hand raise that you want to come up on the stage and ask questions as well. And yeah, in the meantime, feel free to introduce yourself, share what you're working on, share your LinkedIn in the chat, and excited to hand it over to Jeff and Will to kick us off here for today's session.
Awesome. Jason, thank you so much for having us. I'm going to share my screen here. Let me see. I've got hopefully I can.
Yeah, it's right next to the camera icon.
All right, I think I got it here. There we go. Okay, so hopefully you can see my screen now. Gotcha. All right. Awesome. Well, yeah, welcome to Raising Capital with Confidence as part of the Forecastr and Carta webinar series. Excited to team up with my good friend and former colleague, Will Buckstaff at Carta. Will, I'll let you introduce yourself first, and then I'll introduce myself.
Awesome. Yeah, thanks, Jeff. Excited to be here. Excited to chat with you all. Yeah, I'm Will Buckstaff. I've been with Carta for like 2.5 years. So I work on the partnerships team, the BD team here at Carta. I work really closely with our law firm, Accelerator, and VC partners. Those of you who are working with an early stage or a startup attorney or a VC or anything like that know that the startup attorney, the VC, they're all really closely involved in the ownership structure. And that's what Carta helps with, cap table management, specifically for companies. There's a lot of things outside of cap table that Carta does. But yeah, Carta is kind of first and foremost a cap table management platform company. Started out with just digitizing stock certificates, kind of taking paper out of that whole process. And now it's full ownership structure management for companies from pre-seed through IPO. So really helping you all reflect fundraising rounds, actually raise those rounds now too, get valuations, these 409As that we'll talk about a little bit later. But Carta works with about 50% of the VC-backed companies in the US, about 32,000 total private companies. And yeah, so we have a lot of data, a lot of insights to share about cap tables, ownership structure, fundraising, kind of best practices there. And yeah, I've had the pleasure of working with Jeff at Carta and now in his role at Forecastr. So Jeff, kick it over to you for an introduction too.
Awesome. I love it. And Will, how long have you been at Carta now?
2.5 years, coming up on 3 here.
Okay. I love it. So I was with Carta for about 4.5 years before I jumped over to Forecastr, and really loved working with Will. He is an equity expert, so we're honored to have him on here with us. So I am currently on the team at Forecastr. We do financial modeling software that makes it easy for founders to build out a financial model very inexpensively. I'm also a startup founder myself, so I've been in your shoes. Started a company, ran it for about 10 years before we sold that to a private equity group. And then I also have a company called Startup Stack that I'm a founder of as well. Also do a lot of active angel investing. I think I've invested in over 30 different companies in the last couple of years, and love mentoring and helping startup founders. So that's kind of kind of a space I just love to be in. And so it's been fun to get to know Jason and the group here. But why don't we go ahead and we'll kind of set the agenda of what we're going to talk about today when it comes to preparing to raise your first round of capital and having confidence in that. So first, we're going to talk about knowing your investor. And just to kind of set the stage, you may have heard the term KYC, which is know your customer. It's a banking term where you have to know the details of your customer. In that same vein, I like to say that when you're preparing for fundraising, there's a term that's KYX. There are certain things you have to know about certain things. And so it's know your investor, know your numbers, know your equity, know your pitch. And then if you can know all of those things and then put it in one place and wrap it up real nicely for your investors, you will be able to present your company with confidence and be confident going into talking to investors that you are prepared. So that's what we're going to talk about today. And Will, I think you and I can kind of tag team on this a little bit about getting to know your investor. But one thing that I've seen is companies have gone out to raise capital is there's a lot of founders, especially first-time founders, where they're thinking just because a venture capital firm has money, they see that, hey, we just raised a $100 million fund. They think, oh, they should give us $2 million or whatever we need, not realizing that every fund has a different investment thesis that may or may not fit with your company. And so there's a lot that you can do as a founder beforehand, before you even talk to an investor, to know whether or not you might be a good fit for that company. And so, Will, I'd love to get your input on this. I know you see a lot of founders, but any thoughts on why it makes sense to do your research on your investors before you're approaching them?
Yeah, it's critical to do that. Like a lot of times people will think, yeah, just because somebody has money, they're going to invest in everybody. Like you got to look at their thesis. You got to see if you fit in with their investment thesis. You also got to look at the stage of company that people invest in. A lot of times there's seed focused funds or mid-stage focused funds. So understanding that is critical too. I think just to be really pointed in your outreach efforts, like it takes a lot of time and it's legitimately sales for your own pitch and for your company to go raise around and talk to investors. And so being calculated in your outreach definitely helps. But yeah, investment criteria, look at their previous portfolio, kind of the areas that they invest in geographically too. A lot of investors are geographically agnostic now, so they don't necessarily specify that, but it's important to know if that is the case. But also the opposite too. It's like look at investors who do invest like specifically in your area. If you're in an area that has like specific kind of is like a newer pocket of VC, like there's a bunch of cities that are up and coming, like Austin and Florida, and there's a lot of stuff in Boston. Of course, Boston's like a little bit more established, but looking at if there's any geo-specific investors too, and seeing if you could work with them, and kind of get their attention too. So yeah, just really, really important to vet that out at the beginning, because it can save you a lot of time reaching out to leads that may not be a fit.
I love it. And I get asked a lot of times by founders, where do I do this research? How do I get to know what different investors invest in, and if I'm a fit? And there's a couple things. I mean, you can always go to LinkedIn and start following some of the investors that you think might be a good fit. You can initially start out by going to places like Crunchbase or PitchBook, seeing what types of investments different funds have made. There's also a company called NFX. And if you go to their site, they list out all of these different investors. I think they've got well over 1,000 different investors that they detail out what types of companies they invest in, and they kind of sort them into a searchable format. There's another company that we work pretty closely with called Founder Suite, and they're also a great resource to do that initial research. And then once you find investment companies, VCs that might be a good potential fit, go look at them on LinkedIn, kind of follow what they're talking about, where they're at. You can get a good idea of where they're at in their fund cycle. Have they just raised? How long ago was did they announce their newest fund? And it tells you where they're at in the life cycle of, do they have cash to deploy? Or are they in the middle of raising, a fund where maybe they're not as likely to invest? You can also see what types of companies they have invested in. Most of the VCs anyways will publish on their websites their portfolio companies. Things to look for are they investing in companies in your sector? Do they do, consumer products if you're a consumer product company? A lot of times they'll mention what types of companies they invest in right there on their website. Do your research that way. And then look for competitors as well. I mean, know what they have invested in. If there might be a conflict there if they've invested in one of your direct competitors. So those are some tips and tricks that might be helpful as you start to research potential investors. Like Will said, have a hit list. I mean, create a hit list and say these are the VCs or even angel investors that could be a good fit, and start creating that list in a spreadsheet that you can kind of keep tabs on, and then as you reach out to the different groups, keep those notes and add them to your investor update list, so that you can kind of keep you top of mind and keep them informed. Will, anything else to add to doing that initial research or knowing your investor?
I think that was a pretty thorough deep dive. Yeah, I think we kind of covered all the bases there.
We had one question on just going back. What was the name after LinkedIn, Crunchbase, NFX that you mentioned?
Founder Suite.
Okay.
Yep, Founder Suite, another good solution. And an angel list is also a great resource for angel investors for earlier stage companies as well.
Thanks. Appreciate it.
All right. Okay, so let's go to this next section where it's know your numbers. This is an area that trips up a lot of founders, is how to tell your story in the language that your investors speak. Investors speak the language of finance. And so you have to know how to tell your company's story in their language. They speak terms like MRR, ARR, LTV, CAC, all of those types of things. You need to know what those terms are and be able to tell the company story using those terms. So you're speaking the language of your investors. Some of the, as you start to think about knowing your numbers, this is a critical component for any founder, because this is going to help you demonstrate, one, that you know the key drivers of your business, what's going to make this business successful, but two, how it makes money, or how you make money. But then knowing all of this and putting it together in a financial model helps you to not only tell the story, but be able to make decisions for your company, based on different assumptions that you can start to make. So as you think about things that you need to know as a founder when you're going to present to investors, you'll want to know what reoccurring revenue you have. Do you have revenue streams where it's subscription based, or where you've got reoccurring payments? That is, typically, that is great revenue because it becomes predictable for investors. They love to see that. But you need to separate out what your reoccurring revenue is, your monthly reoccurring, and your annual reoccurring, or the terms MRR and ARR. You'll need to know that and separate that out from your one-time revenue. If you've got projects that you're doing, or setup fees or things like that, making sure you understand the dynamics between what's recurring and what's not, and being able to detail that out. knowing what your runway is and how you're going to use the capital that you anticipate to raise. So keeping, being able to predict out what your expenses are going to be, and being able to run scenarios on that, becomes something that investors will dive into, if not, by asking questions at the end of your presentation. Certainly on that second meeting, you'll typically do a deeper dive into, what makes sense in terms of your financial projections. Some other things to keep in mind are just kind of your unit economics, and knowing things like, what is your average contract value? How much, and how long do customers stick around? What is the average contract length, and the lifetime value of a customer? What are the costs, the customer acquisition costs that are associated with customers? You can start to measure these things and then use them to predict going forward. And if you're kind of in that pre-revenue stage, you'll want to track things and make projections based on users. How do you get users? Start defining what are the customer acquisition channels that you have, and then what are the revenue streams tied to those. So those are some of the things that you'll want to kind of look at from a high level. And like I said, the tool that can help you to do this is a financial model. You create a financial model to help you figure out how much money should you raise. Again, this is something investors want to know, that you've thought through, that you're not just saying, well, everybody else is raising $2 million. We think we should raise that too. They want to know why you need to raise $2 million. What does that look like, and what are you going to use it for? So how are you going to spend the money when you raise it? It will also tell you if you need to raise. And so, going through this drill will help you figure out at what point, does it make sense to raise money, and how much? You'll want to make sure that you're able to predict out your hiring plan. What are the drivers behind when you hire somebody, and when can you afford to make key hires in the company's life cycle? Again, going back to your customer acquisition channels, a good financial model will help you determine which customer acquisition channels you should be focusing more time on. You can run these scenarios and say, for example, if we know how much it costs to bring on a new sales development rep, we can put that into our model and say, well, we know that if we do paid advertising, that here is what that looks like. So, does it make more sense for us to hire a new SDR on the sales team, or to put that money into paid ads? If you've got your financials in order, and your numbers, your customer acquisition costs, from paid advertising and all of that, and what the ramp looks like for an SDR, you can then start to make key decisions on what makes more sense and what will have the biggest impact on your business based on your financial model. So those are some key things to kind of focus on as you look at, knowing your numbers and being prepared to talk to investors, and again, speak their language. A couple of resources in this regard. Forecastr has some free financial modeling templates. I am happy to share those with anyone if you're interested. We also have a blog that talks a lot about financial modeling and knowing your numbers. I also wanted to just kind of mention, for anyone that would like help with their financial models, we have a special offer that's available through Prepare for VC, where you get 25% off your first year. And we will also waive the implementation fees, where we'll assign an analyst to go in and help you build out your financial model. For early stage companies, just to give you kind of an idea, it's typically like $1,500 to get somebody to come in and help you build out your financial model in software, and help you learn how to use it and make those key decisions and present to investors. One other thing that's included with that is we allow you to share that information that you start to gather and put together with our network of investors. We've got about 120 early stage VCs that are part of our network, and we allow you to share your information with those investors. So that's kind of a quick thing on knowing your numbers. I'm going to pause here before we jump into equity and let Will talk. To see if there were any questions that came in there that we might want to address. Jason?
Sure. Yeah, if anybody has any other questions, feel free to either put them in the chat, or if you go to the Q&A tab, you can do a text-based question, or a video Q&A is basically a hand raise to come up onto the stage.
Awesome.
And also to do a quick plug for Forecastr there. A lot of startups work with Carta, and Forecastr is very adjacent to Carta in a really cool way. Like the modeling for your round for your own finances is really critical before a round, right after you raise too. Just like and I've just heard really positive feedback from people working with Forecastr as it pertains to the templates and kind of a lot of the resources that they give there. So Forecastr is doing some really cool stuff as well.
Awesome. Thanks, Will. Well, Will, I'm excited to have you talk a little bit about equity and this critical component of knowing your equity.
Yeah. And knowing your equity it's a really critical concept at later stages for sure. So I don't know if any of you have worked at Series B, C, D companies, kind of those later stage. And sometimes the cap tables can get really messed up, and that's like complicated to fix. And there's a lot of lawyers in that. And Carta started, like the initial pain point for Carta was these like Series B, Series C companies saying like, hey, we got this really messed up cap table and our lawyers are charging us a lot of money to do it. Full disclaimer, Carta works really closely with lawyers. We can't give any legal advice, so the lawyers can. They get onto the Carta account and they can help clean everything up. But we really started out by working with these like later stage companies. And then we realized, hey, it's actually a little bit down the line, and kind of in the last like 5 years, hey, these early stage companies, when they get to a raise, you can run into a lot of roadblocks if you don't have everything in order. And so we started working a lot closer with these early stage companies, but kind of pre-first raise, because, you know, when you, and a lot of you have probably been through part of this journey that I'm about to explain, when you start your company, you're going to incorporate your company, you're going to issue out some founder stock. Maybe you have some advisors that you give grants to. And you're going to kind of have that early stage equity that's going out. And then maybe you have a few convertible notes or safe investors. And it looks really simple, but it's really important to understand what's in those terms and what things are going to look like in the future. And so a clean cap table is really critical, and not only helping you get through a financing round, because lawyers and investors will need a really accurate and clean snapshot of your ownership structure to be able to invest new money into it. But it's really critical at the early stages for knowing kind of what things are going to turn into in the future, and how much you will hold after a round, how much investors will have once, you know, say for example with a convertible, they convert onto the cap table. But like specifically, like the granular reason too for a really clean cap table at the beginning stage, right before you kind of go into a financing round, is to actually conduct a financing round. There's required thresholds by different holders in the company that to get to a certain percentage of ownership to say, hey, we're allowing this financing round to happen. They're called threshold calculations. And if you don't know your ownership, if you don't know it crystal clear, that may not be able to take place. And then what typically happens is, it's not like your round just doesn't happen, but what typically happens is that you're gonna have to pay some attorney, some ECVC lawyer, a lot of money to go fix stuff right before your round at kind of the 24th hour. And then you're gonna look at your $20,000 bill the day before your seed financing round and be like, what is happening? And if there's really good ways to streamline this at the early stage. Yeah, getting onto a cap table software can definitely help you. But I also think just having the conscious effort of saying, hey, this is who holds founder stock. We haven't created an option pool yet. This is who holds what in the company. These are the advisors. These are the safe and convertible holders here. This is what they're going to convert into later. So whatever methods you can do to understand that before your financing round will save you a lot of headache and time. You want to spend a lot more time negotiating with your investors and not doing clerical cap table fixes. But it's going to save you a lot of money right before your financing round too. And so the cap table is one piece of it. The other thing too, as far as like financing rounds, is, you know, I mentioned founder stock at the beginning. That's one of the early things to do. But the other piece of it too is when you issue out options to employees, you're going to have to price those options. And so there's a valuation that is kind of required by the IRS, saying, the company itself can't price their own options. There would be a lot of tax kind of advantages and conflict of interest if you were pricing your own options for employees. And so the IRS requires what's required is a 409A, which is a third-party valuation to price those options. So of course, that pertains to the cap table options. When people exercise them, they go onto the ownership structure. And so a 409A typically happens when you have a change in FMV at the very beginning stage. When you create that option pool and issue out options to employees, you'll need to get what's called a 409A valuation. And so kind of the cap table management software and the 409A are probably like the two ways to keep things cleanest as you go through a financing round. So Carta does offer those two things, but just as a heads up, whether Carta or not, kind of wherever you do this, it's important to think about those two things because of the legal headache it can cause if you don't, right? If you don't get a 409A to price your options and then down the road you go through an audit and someone's asking, hey, what did you use to price these options? What was calculated in there? It's important to have an audit defensible valuation for that. And then the next piece of it too is ownership and dilution. So there's the keeping the cap table clean part of it that's going to help you with legal billable hours, right? And at the end of the day, like lawyers actually don't want to bill you for those administrative tasks. Like that's not fun on their end either. It's just something to keep working with you that you got to get through for the financing round, and it can take a lot of time if you're not prepared. They would rather spend time advising you. They would rather spend the time helping you manage your business and help you with strategy legally, and not with these kind of clerical tasks or having an associate partner have to work on something right before a financing round closes so that the ownership structure. Those first two bullets are going to help with that. The next piece of things is kind of the ownership and dilution model. So understanding what ownership is going to look like after the first financing round too. And it's important to be able to not only know that as founders and be able to communicate that to investors, but also to be able to talk to new hires, candidates, and then know what your own equity is going to look like down the line. So there's a lot of great modeling resources out there. Carta's got a free one if you have any safes or convertible notes. That's just safes.carta.com. You don't have to be on Carta for that. But understanding that ownership and dilution is critical because investors are going to want to know what other investors own. And I think just at the early stage, one thing that you can't stress enough is know what your convertibles and safes are going to convert into. Know if somebody has a fixed percentage safe. Know if you're working with a pre or a post money safe and what the differences between those are. Just a little spark note, on average, pre-money safes are less dilutive and post-money safes are more dilutive. Post-money safes, of course, are way more common though. And so it's important to know the terms of a safe and of a convertible note. People raise on safes and convertibles because they don't cost that much, because there's not too much due diligence that goes into it, not that many legal billable hours that are required for a safe and a note. But don't confuse the simplicity of safes and notes, mainly safes, for not understanding what's in them. Although they may be templated forms, sometimes they can be really advantageous to investors and can be extremely to companies. And so it's important to know what's in a safe. There's great resources to read about the implications of post-money safes versus pre-money safes. Same thing with different terms in convertible rounds. And understand if someone has pro rata rights, right? If somebody has the right to retain their percentage in the company from their initial investment at a later round, you got to understand the implications of that too. And have those conversations with investors. Modeling that stuff out is critical. So we talked about safes and notes, purchase agreements, and then the stock option plan. So circling back to the 409A quickly, that's kind of, those two go hand in hand, right? At your first financing round, you're going to create a you're going to create an option plan, an option pool. You're going to set something aside. Typically, investors are going to ask you to set that in the pre-money, meaning the pre-money valuation for your company. for a couple kind of technical reasons. Investors will ask for that because it dilutes them less. But stock option plan is important to consider because you have to retain current employees. You need a stock option plan to hire new talent and incentivize them with equity grants. We could spend a lot of time on equity grants and the implications of those, but we're not going to today. But just know that kind of that 409A is critical when you're setting up that option plan to price those options, because you need a third party to do it. And all of this in a nutshell, I know there was kind of a lot to cover there, and there's a lot more to unpack. And if any of you ever want to like just chat about this, I'm happy to talk on a call with any of you all. But the last piece of advice, which I think is the one thing you should take away from this slide, is get a really good startup attorney. It's important that somebody knows the ropes of startup financing and just early stage companies and formation, capital raises, equity grants, what the implications are there, because there's a lot of technicalities around that. So get a really good startup attorney. If you don't, I'm sure there's some, Jeff's got a great network. I'm sure Prepare for VC knows a lot of good startup attorneys. I do too. I work with them most of my day. But it's important to get a really good one so that down the line you can look at your Series B company and say, hey, we did this right at Series Seed, and now all of our equity comp is correct. The investors know what they own. Everything's clean. It'll save you a lot of headaches. Jeff, anything to chime in and add there?
I mean, I just noticed that we underlined startup in the startup attorney. There's a lot of different types of attorneys out there. Make sure that the attorney you're using is specifically works with startups in this space, that they know what a Series A is, and they've done, seed rounds, they've done, safe notes and Series A's, all of that stuff. So, Will, that was awesome. One thing I wanted to mention was Prepare for VC also has a special offer on Carta, where you can receive a 20% first year discount for capital management and your 409A valuations. So, I mean, if you're going to be issuing stock options, definitely reach out to Will. They also have a free launch plan that is for companies that have raised $1 million or less and have 25 or fewer stakeholders. So I'll just say, from an investor standpoint, when I see a company is using a tool like Carta for managing their cap table, it increases my confidence. I'm like, okay, these guys have things together. They're using the right tools. And then, if they've got a good startup attorney, again, that helps increase my confidence in, making this investment. So keep that in mind. Carta is awesome. I love when companies I invest in, when they're on Carta, I'm like, yes, because it makes my life so much easier as an investor as well. Okay, so let's move on to this next one. We've got a few more minutes to cover a couple of things, then we'll open it up for Q&A. But another thing that you need to know is your pitch deck. So know your pitch. This, again, is something that I think founders stumble on it from time to time. I can't tell you what a huge difference it makes when a founder comes in and is well-versed in what they're talking about, as opposed to coming in unprepared and just kind of fumbling through a presentation. It is night and day. And so one of the keys when it comes to presenting your startup is to practice. The more you pitch your startup and tell the story, the better it is going to get, and the more confident you're going to be. So practice is the key to a good presentation. The other thing about that is that as you present, you are going to, one, get experience. So you're going to increase your confidence the more you present. But it's also, you're going to get feedback, and you're going to know what resonates with investors, what doesn't, and you're going to learn. And so your pitch is going to get better and better and better. Just to set expectations, I mean, typically as a founder, you're going to present your company hundreds of times. And that's what it takes. I mean, you can tell founders that have gone through their presentation hundreds of times versus those that are doing it the first few times. Take advantage of opportunities like your local 1 million cups, or pitching to friends or team members, and and practicing before you go in to meet with investors. Take every opportunity you have to do pitch events. If you don't win, you're still getting that experience, which is really invaluable. In terms of putting your pitch deck together, there are certain things that you need to have. And so I know there are some times where founders feel like, well, we want to be different. We want to stick out. We don't want to just do the normal, problem, solution, market overview, all of those things. And so they try to get creative, and then they end up leaving out critical elements of the pitch. So if you are going to get creative, and that's good to want to, stand out, but don't do it to the detriment of leaving out critical elements. There's reasons that certain things are typically included in a pitch deck. Investors need to know that you know and understand the problem that you're trying to solve. And then obviously you can talk about your solution. That's what you're going to be focused on. But one of the keys as you're building out your pitch deck is if you can define the problem and get it to where your investors get the problem, the rest of your pitch is going to go so much better. If your problem is unclear and then you jump into the solution, it's going to derail your presentation right from the beginning. So make sure you identify and can articulate the problem you're solving and help your investors to understand why it's a problem, and then you can go into your solution. There are things that are critical. I mean, especially for an early stage startup, there's going to be, your experience as a founder, and that team that's going to execute on this plan. Early stage investors are going to be really taking a bet on you as a founder and the founding team. And so, if you come across, one, knowing your numbers, knowing your equity, knowing about the investor that you're talking to, all of those things are going to create that confidence in yourself, but that's going to be portrayed to your investors, and them having confidence in you as a founder really is the key element, particularly in an early stage, investment. I will also just mention that, if you're in a situation where you're presenting to accredited investors, your ask slide is probably the one that's going to get the most attention. So again, it needs to tie back into your numbers and reflect, how you're going to use the capital, how much you are going to raise, and, potentially the terms that you have if you've got a lead investor, what those terms are, so that they know. And then you if you leave that ask slide up as you go into Q&A, that becomes a great discussion point that kind of, helps you dive into the details on, why you need this much money, what you're going to do, and where that's going to get you. One thing to wrap that up is, also be prepared with some appendix slides. You want to keep, depending on, what the pitch environment is and who you're presenting to, you might leave out certain slides. I would also say to have a version of your pitch deck so that you have a, typical standard 8 to 7-8 minute, presentation. Also practice a 3-minute presentation. There are a lot of times where you'll have 3 minutes. Know your 60-second pitch, right? So practice all of those. And by doing your 3-minute pitch, your 7-8 minute pitch is going to be a lot better, because you're going to know what elements you have to focus on and what the key things are. So practice and have a 60-second, a 3-minute, a 7-minute, and a 10-minute presentation that you're ready to go with at any time. There's a couple resources here before I jump to those. Will, anything you wanted to add about knowing your pitch?
Yeah, I think I think one thing, I mean, you covered just, I think just kind of the whole thing there. I think one additional piece that I've heard recently, Jeff, you're an investor more so than I am. I'd love to hear your thoughts on this. It's just like also having just a good roadmap and timeline too, just in there of like, hey, this is when we're going to be solving this. This is kind of the timeline for execution. Jeff, what do you think about that?
That's absolutely critical. I mean, showing what you've accomplished to date and then what you're going to be accomplishing going forward really helps paint the picture for your investors of, if we put this money in, this is where it's going to get us in 12 months or 18 months. And, this is what we're working towards. But then identifying those critical milestones, so you can talk through that with potential investors of, okay, what does it take to get there, and what are some of the hurdles we'll need to overcome. Having that timeline and putting that out there is critical, because if you really look at it, I mean, especially if you're raising a safe or a convertible note where it hasn't converted into equity yet, your investors are going to want to know, when can I expect this to convert? If it's going to be like 5 years before you raise another round and you're wishy-washy on what the timeline looks like, the confidence in your investor is going to go way down, as opposed to saying, here's the milestones we're going to hit by this date, and then this date and this date, and you lay that out, confidence goes way up. Great point, Will. Okay, so a quick couple of resources. One book that I highly recommend is by Tim Cooley. It's the Pitch Deck book. Tim goes through and identifies the key elements that you need to have in your pitch. And it'll, more than anything, it will help make sure that you're not leaving out something that is critical that has to be in your pitch. And then there's other tools like pitchpages.io that can kind of help you create a great pitch deck. Okay, we're going to wrap all this up now. And Will, I'm going to let you talk about the importance of data rooms once we've done all of this work and we know our investors, we know our numbers, we know our equity, we know our pitch, and now we need to put it into one place.
Totally. Yeah. I mean, data rooms are really important. It's the information spot hub where you're sharing stuff with investors. You want a data room, that's easy to share. You'll want a data room that has like downloading permissions, timestamping, allowing you to see if someone's viewed a document. There's a lot of intel you can get from a data room if you get a data room that allows you to do that. And it's important to know who's engaging with the material that you're sharing, who's downloading it, who's looking at it. So data room can matter a lot if you draw insights from it. And you can also, of course, it's going to help keep everything in one spot and just speed up your close, right? If you have a data room that has your pitch deck, your financial model, your historical funds, your cap table, any sort of legal and investment docs, stuff related to IP, your board, LOIs, it's just going to speed up your close. There's a lot of things that can speed up or slow down your close. You don't want to be thinking about really any of the things that can slow you down in the last 10% of closing your financing round. Having all of those in one spot, sharing with investors can really benefit you there. Carta's got a free data room in every single one of the accounts. At the early stage, a data room doesn't have to be anything crazy fancy. You just want something that can track who's downloaded, who can timestamp, you can watermark your own docs, and just understand, and also have an NDA functionality in that too. It doesn't have to be anything souped up or fancy. It's just important to have everything in one spot and then be able to draw intel from it, and then be able to help have that facilitate you closing your financing round a lot faster then. Jeff, anything else to add on that?
Yeah, I'll just say a nicely organized data room, again, helps create confidence in your investors. It's like, these guys know what they're doing. They've got everything all ready. And so when you get asked, okay, can you send over a cap table? You just shoot them over a link to your data room. And if they can, it's well organized, they know right where to go, and they just go click on the cap table and goes to your Carta account or whatever. So having that ready to go is going to make you feel more confident. as a founder, because anytime somebody has a question or says, hey, can you get this for me? You just point them to your data room where everything is. You just keep that updated. But then it's going to also make your investors a lot more confident in seeing that you've got everything put together. So very critical. I actually have a template of what you might include in a data room. If anybody wants that, I can send out a follow-up link to that template, if that would be helpful. Okay, well, that kind of wraps things up on our end. We can open this up for Q&A. I did want to share our contact information. Will mentioned, feel free to reach out to him if you've got any questions about equity, the Carta free plan, or a discount there. If you need help putting together your financial model, and we can help there, we've got free resources at Forecastr that will be helpful for you as a founder. And then that special offer as well. Feel free to reach out to me if that's something that'd be helpful for you. And feel free to take our email addresses down and connect with us on LinkedIn. I'm going to stop sharing, so feel free to grab our email addresses while it's up here. And then as we go into Q&A, I will stop sharing my screen so we can see the chat.
Sweet.
Amazing.
Jeff, I'll just, all right, just Jason.
Oh yeah. Did you want to share anything before the Q&A?
Oh, I was just going to do that one question that Alicia asked and kick that over to Jeff.
Sure.
Oh, what's this? How do we create financial projections for a pre-seed or pre-revenue startup? Excellent question. So when you have, when you're creating financial projections, you typically start out with your customer acquisition strategy. So even if you don't have any revenue right now, you need to understand, how are we going to get customers? And have you tested that out? Do you have a free plan that you're using right now? Or are you waiting for, your product to be built, and so then you can start to offer it and sell it? Starting out with, how are you going to get customers? Are you going to be using paid ads? Are you going to be, is it, an influencer network? Is it through partnerships? Knowing and defining all of those things, you can start to then make some assumptions and say, okay, well, in order to roll out our partnership strategy, we need to have, we've identified 3 different partner channels, and here's some of the assumptions behind that each partner would refer maybe three individuals per month, or whatever is relevant. And then you can start to build that out and say, okay, with these 3 customers that are coming in, next month, once we release the product or whenever, what are the revenue streams tied to those customers? Is it a one-time purchase upfront, or is it a annual subscription? And what is our close rate? If they refer us 3, is it going to be one of those that we would anticipate to be? Or maybe it's like each partner is going to send over 300 leads, and what does that lead conversion start to look like? You can start to pull some of those things from your potentially from your competitors or from industry benchmarks. But the key is to know some of those things and then put those assumptions in place. And then as you start to go down that path of seeing, okay, our partners are actually, instead of 300, they're only sending us 250 on average, leads, and here's our conversion rates. You can then start to tweak those things in your model, and your model will get more and more accurate over time as you start to get that, get real data in there. But those assumptions become, just kind of tools to help you to see where you need to be as a company in order for the business to make sense.
Totally.
Yeah, great answer.
One quick addition to that,
Sure.
important in the early stage rounds. I'm not too familiar with the financial projections for pre-seed and pre-revenue like Jeff is, but for pre-seed and pre-revenue, an important thing is also pricing the company for your FMV. I'll just tell you quickly what the methodologies are for that. That's the FMV for when you create an option pool issue out those options to employees, you got to price them. And that's basically comes up with the FMV, the fair market value for the common stock. The way that folks or people who do 409A, so Carta or kind of whoever's doing a 409A prices that side of the business is usually at the early stage. If you have any sort of cash flows, is the DCF, a market-based approach, like any sort of market multiples. But the most common for pre-seed and pre-revenue, just for your knowledge, in case you were curious, is what's called cost to recreate. So when pricing options, usually people will use cost to recreate, meaning your IP, your computers, your office space, anything to recreate your business. How much would that cost? That's typically one of the biggest factors at the early stage in pricing out your fair market value of your common stock to be able to set that strike price to issue out options from.
Yeah, great advice. If you're especially like if you're 2 years into the business, you've done a lot of development work, you've found amazing talent, and you have a large customer base already, or even if you have a small customer base, like what is it going to take somebody to do that from scratch? So yeah, love that way of thinking as well. We had a question from Alexandra here on this looks like a pitch deck question on whether you put the total amount of funding or specifically target to the smaller investors that you're targeting for their check size.
Yeah, excellent question, Alexandra. You do want to have something defined as to how much you're going to raise for the company. So you need to know how much you're going to raise and how that total amount is going to be used over the next 12, 18 months. Because what the angel investor, for example, they might only write checks of $50,000, but they need to see how much the total amount is going to be raised that they're going to be putting in, and contributing to, so they can kind of see your plan ahead and what they're really investing as part of. It would be totally different if you're going out and saying, okay, we only need $50,000 to get us to this point in the next 6 months, as opposed to, okay, we need $3 million. We know you only write $50,000 checks. We need $3 million. And here's how it's going to be deployed over the next 12 months. And here's where it's going to get us to. As you start to get in those discussions, it's very helpful to start to, pull in things like we've been talking to, we've identified a lead investor that's very interested. We're in discussions with 3 potential lead investors. We have, we're raising $3 million. We have, 1.3 million soft circled in terms of soft commitments, where they've said, hey, as soon as a lead comes in, we'd love to participate. And so that's how you can kind of position that. So even if they're writing a $50,000 check, they see that they are part of a bigger plan, right? Hopefully that makes sense.
Perfect. Yeah, great response there.
That's a really good question too.
And then we have another one around getting traction before traction at the pre-seed round, how you find the individual angels or family offices that might not have portfolio sites like a VC does.
Yeah, excellent question. Those elusive angel investors and family offices. I mentioned Angel List. You can kind of go on there. The other thing is, just through networking, looking at things like LinkedIn and connecting with folks that are kind of in a space that's, the space that you're interested in. And then going to events, getting out there, it becomes critical. Other founders can often be your best resource for other potential investors. So, connecting with other founders that might be in your sector, that somebody that might be ahead of you. If you're raising a seed round, they're moving on to they're raising their A round right now. Talking to those founders and saying, hey, where did you guys go? Who were some of the investors that you guys were kind of talking to? And getting a good feel from other founders is a great resource. looking, I mean, there's accelerator groups out there. There's, different communities, entrepreneur support communities. I mentioned that like Forecastr, we've got, 120 early stage VCs that are part of our network that invest in different companies. But a lot of the accelerators will also have a great network of potential investors. So those are some ideas. Will, I don't know if you have additional ideas that you see founders taking advantage of, or Jason, you as well.
Yeah, I think one thing that's interesting is go look at companies who've raised like A rounds or seed rounds in your industry or in your geo. And then you can see that on Crunchbase or on PitchBook or on any sort of like article about it. And then go look at the angels who tagged along with that or who were there early and see who's active in either a certain geo or an active industry. And just look at all the companies in your industry or in your geo that are raising and see who's playing ball with them too. And then you can hit them up and just kind of like cross-reference them to get to the most likely participants for your industry or your geo.
Yeah. One other thing I was just thinking of was sometimes you go to people that are in the VC space. So I know a lot of times when I'm, meeting with a founder, I'll loop in my contacts over at Silicon Valley Bank, for example, and they know all the angel investors, the VCs. So groups like that deal in that space, get connected with them. Even if they're not going to invest in your company, they know a lot of the, angels and investors in different ecosystems.
Yeah.
Yeah,
Yeah,
exactly.
Jeff, that's the play smarter, not harder for sure too. Like if you can get connected to a group that knows a bunch of angels, that's great. Like there's the other side of it, which is like be fanatical at prospecting and go find these people, which is great too. But yeah, Jeff, that's fantastic advice too of plugging into a bigger network.
Yeah. There's I think, yeah, those are all great examples. There's angel groups too, which are, groups of individual investors coming together for deal flow and meetings and due diligence. And, that's a great place to look. There's also, different kind of publicity of the angels. So, some are pretty active in speaking at different events or going out to meetup groups. And, those ones are easier to find and connect with as well, which, if you go out to an event somebody's speaking at and meet them and, kind of making those cold introductions warmer can be a great place to start. And then, yeah, I love both of your advices on kind of how you can, leverage the network, whether it's other founders or, communities or people that you can ask to see, how did you, who do you recommend that I talk with? And, it can even be other investors you're meeting with and say, you know what, we had a great meeting. I'm looking to meet some other investors in your network, and who should I be getting in front of?
I love it.
Cool. So yeah, no, appreciate all the great advice and questions in the chat today too. And yeah, we shared in the chat as well, like on our resources page for Prepare for VC, we have a Forecastr and a Carta offer for any of the community members here as well. And yeah, appreciate you sharing your email in the chat too. So, anybody looking to connect afterwards, feel free to connect with Jeff or Will, or reach out to me, and you can follow up with any other support we can offer as well.
Awesome. Love it. And I saw a comment about TBD Angels, great group there in Boston for anyone that's in that area. So thanks, Rachel, for sharing that.
Awesome.
Perfect. Yeah. No, thanks again. And yeah, well, actually, this event link, so the same link you used to join today, will turn into a recording within about 24 hours. So you can go back and, watch and learn from Jeff and Will again.
Awesome. Jason, thank you so much for having us. Thanks to everybody who joined us today. And like I said, feel free to reach out to myself or Will if you have any additional questions or if there's anything we can do to be helpful.
For sure. Perfect. Yep. Thanks so much, Jason.
Thank you. Have a good one.
See you guys.